Hello, everyone. This will be my video presentation for healthcare finance class for the reflective video assignment at the end of the semester. Okay, so let's get started. So first, a little about myself. My name is Li Fan, and I'm studying the Master's in Healthcare Administration at University of West Florida. Um, I should be graduating in spring of 2024, and currently I am a research ophthalmic photographer at Bascom Palmer Eye Institute here in Miami. I plan to use my degree for process improvement, both in my work and outside of the work. And also, I'm looking to use this degree for my career growth. And so far, I have learned quite a lot from this, from my times at University of West Florida. I've gained a lot more critical thinking skills. I have learned a lot more about healthcare systems, and I also learned about data analysis in healthcare. So all of those are very helpful in to me personally. So let's get started into the actual assignment. We'll be discussing about the structure of the finance department. So the finance department usually have three persons in charge, and the first is Chief Financial Officer. We usually call them CFO. They report to the CEO, and they oversees all finance activities. And secondly, we have the controller, sometimes also called controller. They are responsible for all accounting activities, such as budgeting, financial statement preparations, billings, and accounts payables. And the third person is the treasurer. And treasurer is responsible for capital management, cash debt management, lease management, and financial risk assessments. And next, we'll be talking about the roles of the finance department. So the primary role of the finance department in healthcare is actually to plan for, acquire, and use resources to maximize the efficacy and value of the healthcare organization. There are a few key insurance concepts. So in general, individuals are risk averse and will be willing to pay for a premium over their expected loss to eliminate the risk of a financial ruin. And that's the basics of insurance. So it's built upon people willing to pay extra money to avoid a higher risk. And so there are a couple concepts. There are pooling of losses, which is meaning the losses are spread over a large group of individuals so that everyone realize the average loss of the entire pool. So that you pay less of the money out of the entire risk that's being evenly distributed among all the members. There's payment for random losses, which means payments are only made for random losses. So if you intentionally make a loss, it is usually not covered. There are risk transfers. So the risk transfer transfers the risk from insured to the insurer to better bear the risk due to better financial position of the insurance company. And there's also indemnification, which is reimbursements to the actual insured after a loss. Adverse selection meaning or it occurs because individuals and business are more likely to have claims and more inclined to purchase insurance than those that are less likely to have claims. Okay, so higher risk people tends to purchase insurances. And there's moral hazard, which so a example is the owner who deliberately sets a falling business on fire or deliberately crashes a car onto a wall to collect insurance claims and knowingly know that the car was not good or that business is failing. And this occurs in healthcare, but it's less pronounced, and usually it pertains to patients actually uses excessive services that are not medically required. So next, we'll be talking about third-party payer system. So a large portion of the health service sector receives its revenues not directly from the patients, but mostly from third-party insurers. They're known collectively as third-party payers. We also have private insurers. Private insurers includes Blue Shield, Blue Cross, which started back in the early 60s. They provide coverage nowadays for about 106 millions of individuals, both in the United States mainland and across. There are commercial insurers such as United Healthcare, Humana, Aetna. They are usually life insurance companies that also provide some of the healthcare insurance coverages. There are also self-insurers that are individuals who sets aside an emergency fund. So they don't really rely on insurance. They have their backup funds in case a catastrophe happens. We also have some public insurers. So Medicare and Medicaid are two excellent examples of the public insurers. Those cares are funded by the governments. So the Medicare provides benefits for mostly patients over years of 65 and older, and Medicaid provides benefits for low-income and disabled individuals. Next, we talk about managed care plans. Managed care plans combines the provision of the healthcare services and the insurance functions into a single entity. So, some examples: healthcare or health maintenance organization. We usually call them HMOs. They combine financing and delivery of healthcare into a single system. So, in theory, it provides a strong incentive to prevent rather than treat diseases early. Okay, so the disadvantage, of course, you have very limited provider choices, and they often requires referral from primary care provider if you actually need specialty care. Okay, and on the contrary, we also have preferred provider organization. Those are, we usually call them PPOs. They don't really require referral for you to see a specialist, and you have more provider choices. But they usually provides a better incentive for in-network providers. So the advantage of PPO, of course, are those, but the disadvantage is usually PPOs costs a lot more than a HMO plan from your employer. Financial statements in healthcare includes a few key ingredients. So we have the balance sheet, which provides a snapshot of the financial position of the organization at a given point in time. We have the income statement that summarizes the operations of the organization and with a focus on revenues, expense, and profitability. We also have statement of change in equity that indicates how much of an organization's net income will be retained in the business and hence increase the amount of equity shown on the balance sheet. Next, we have statement of cash flows. The statement of cash flows provides external and internal users with better information about the firm's cash flow, both inflow and outflow. Usually there's the optional section called notes. They're not required to be included in the financial statements, but sometimes it contains information on topics as accounting practices, the composition of the long-term debt, the pension plan status, amount of charity care provided, and the cost of malpractice insurance. So other things that are generally not included in the financial statements are here in the notes section. The components of the income statement. So the income statement reports the organization's operations over a period of time. There are three key components. There are revenues, there are expenses, and profit measurements. So the revenues can be shown on income statement in a few different forms. And it's mostly concerned with net patient service revenue after discounts. Because this is your bread and butter, you rely on patient services, build patient services to be profitable, to stay in business as a healthcare organization. So expenses are economic costs associated with providing services. Some examples include the supplies, the salaries, depreciations, insurance, and such. So also on the income statement, we have profit measures. So some of those examples are statement of change in equity, which shows retained total profitability, which just means net income. And we also have financial ratio analysis. So those analysis actually combines values that are found in the financial statements to help managers and investors interpret the data with the goal of making judgments about the financial sounding of the company, whether the company is doing good or the company is losing money. There are operating income, net income, and cash flow. So the operating income in healthcare actually focuses on the revenue and expense that are related to operations, which is the provision of the patient services. The net income basically means the operating income plus the total non-operating income. You need to have a positive net income to be profitable. If your net income is in the negatives, your business is not doing well. The cash flow can be thought as a net income plus non-cash expense, such as your depreciation expenses. And a organization's financial condition, at least in the short run, actually depends more on the cash flow into and out of the business than it does on the reported net income. So cash flow is also an important factor when judging a business's profitability and financial standing. Next, we have balance sheet. The balance sheet actually presents a snapshot of the financial position of the organization at any given point in time. It reflects a business's financial position on a specific date. The data typically becomes invalid the very next day. And usually the classic example of the balance sheet is assets equals liabilities plus equity. The balance sheet is two-sided. So on the left side, you usually have assets. On the right side, you have liabilities and equity. Both sides must balance. That means assets must equal total liabilities plus total equity. Assets either possesses or create economic value for the organization, and liabilities and equities together actually represents the capital that has been raised by the organization to acquire the assets shown on the other side, which is the asset side. Statement of cash flows is created by accountants in response to demands by users for better information about a firm's cash flow, both inbound and outbound. So it details where a business gets its cash from and what happens to them. So couple sections in the cash flow. There are operating activities, which include sources and uses of cash that are tied directly to operations. We have investing activities that actually include property and equipment investments and securities investments. We have financing activities that usually includes the use of contributions and securities to finance a business's operations. And we also have net increase of cash. So this section actually summarizes the total sections, the three sections we described above in the reporting section. Next, we talk about cost behaviors. There are fixed and variable costs. So the fixed costs is known with certainty, regardless of the volume within a relevant range. Some of the examples includes rent, salaries, and insurance. Those are fixed costs that comes every month, and you know the exact amount. There are also, on the other side, there are variable costs. So they are directly related to volume. So the more you use, the more it's going to cost. A classic example would be medical supplies. Keep in mind also some fixed costs actually may be converted into variable costs, such as hourly wage, because you don't know when an employee might work a little longer and work less. Some of the capital equipments, MRI machines, are usually on a lease. So depending on the use, those costs are actually variable instead of fixed. We have an underlying cost structure. It is a relationship between an organization's total costs and its volume. So the underlying cost structure actually provides the managers with a tool for forecasting the costs and ultimately, of course, the profits at a different volume. So it forecasts if the volume increase, what the cost is going to be, or if the volume decreases, what the cost is going to be. So next, we move on to profit analysis. There are two different kinds of reimbursement structures. There are fee-for-service reimbursement structure. There are also capitation reimbursement structure. So in fee for service, the profits are actually based on revenue minus total costs. So in this kind of structure, it's only profitable if the total revenue is actually greater than the total cost of the service. And we should utilize break-even analysis to actually establish a break-even point. So in turn, we make sure we don't lose money. So there are two break-even points. There are accounting break-even points, which is the minimum required to create a zero profit. And there are also economic break-even point, which is the volume actually necessary to establish a specific profit level. So you need to reach accounting break-even point to not lose money, and you need to get to economic break-even point to make money. Under capitation reimbursement structure, the profit is actually based on service utilization of the covered population. So this structure is only profitable when the premium collected is actually greater than the service rendered. Okay, so the less service the patient uses, the more money the organization is going to make. So fee-for-service reimbursement, of course, maximize profit by increased volume of services, and capitation maximize profit by utilizing the least amount of service provided of the actual covered population. The cost allocation, we talk about the goal of the cost allocation, which is to actually assign the overhead cost of the organization to the departments that causes them to be incurred. The classic example, of course, is the patient service departments, where they actually generate revenue. Okay, so the motivation to improve cost allocation comes from the increasing pressure to optimize economic performance within the organization that focuses on financial performance. And it's both important for nonprofit and for-profit organizations, because every organization needs to be able to make money and be efficient at making money. In cost allocation, I think the most important factor is the choosing of the cost driver. And it is actually the basis for making allocation from a cost pool. So the identification of the most effective cost driver is absolutely essential to actually a very sounding cost allocation system. Next, we talk about purpose and objectives of healthcare financial administration. So the purpose of healthcare financial management is actually to provide accounting and finance information that helps healthcare managers accomplish the organization's purpose. There are a couple major objectives of financial management in healthcare. We need to be able to generate income. We need to be able to respond to regulators, and we need to facilitate relationships with our third-party payers. We also need to influence the method and the amount of the payment with negotiation to the service providers, and we need to monitor physicians on their performance, and we also need to protect our tax status. And there are 3 steps in healthcare financial analysis. So the step 1 is actually to establish facts about the organization. We need to review the organization's key financial statements, income statement, balance sheet, statement of cash flows, etc., to make sure those statements are accurate and sounding. And step 2, we actually need to compare facts over time and then compare it to other organizations of similar capacity. So we have a good comparison, horizontally. So we compare from the past years of operations, as well as compared to similar organizations, which usually includes ratio analysis, horizontal analysis, and vertical analysis, as I talked earlier. So in step 3, we actually use perspective and judgments to make a sound comparison. So of course, we must be able to use all the values, use all the comparisons that we've learned to make a financial decision in healthcare. Next, we talk about managed care organizations. So a managed care organization, actually we touched about this earlier and included 2 of those earlier, is an organization that controls the cost of the healthcare, the quality of the healthcare, and access to healthcare. There's one classic way to one way to classify the managed care organization is this little chart that I've shown below. So on the top, on the left side, you see managed indemnity, and on the extreme right side, you have closed panel HMOs. So the two things we talked about, the PPO is actually in the middle, and the HMO is on the right side. And on the bottom of the chart, you can see um, the more you move to the right side, the more complex cost it's going to get, and the more administrative cost it's going to incur for the employers. So really, it's all about a balance and choices of the employer on which kind of managed care that they like to use in their organizations. Um, Beyond managed care methods, we actually have post-managed care. Some innovations recently that came to light included defined benefit plan. Those kind of plans, so the employee actually receives a defined benefit package, and the employer and the employee both pays the premium. So the rate is actually adjusted each year based on the experience of the package. We also in post managed care have direct contracting method. So those kind of method, some of the larger employers are able to make contractual agreements directly with healthcare providers. So they accept the financial risk and deliver the full range of healthcare service. So this way, actually, both the employers and the healthcare providers saves money because they actually cuts out the third-party insurance providers. So this saves on the administrative costs of providing services. Next, we have consumer-driven plan. Those plans also became popular after COVID. Those plans actually helps individuals choose their healthcare providers and financial incentives that are provided to encourage them to request only appropriate amount of healthcare service, so they don't overuse the healthcare service that are available to them. Very last, we have a high deductible health plan. Those plans also came into light after actually Obamacare. Those provides I guess, catastrophic coverage only for the worst case scenario. So if you need regular care, those plans are going to be very expensive because the deductible is very, very high. So you're going to pay quite a lot of upfront cost. The benefit for those plans is for people who know that they're very healthy, who also assess their risk to be low, and they want to reduce their cost of the monthly premium, and they could be choosing those plans which are very affordable and also provides emergency coverage if you need them. And this actually concludes the whole video. Thank you so much, guys, for watching at my presentation. I hope you actually found this presentation helpful. And at the very end, I'm going to show you guys the reference that I've used for the class. And once again, thank you so much, and I'll see you guys in the next class. Take care.